Good morning, ladies and gentlemen. Good to see you all back again for Boutiques on Wednesdays. Olga, thank you for that upbeat music as usual. SA bonds are one of the top performing asset classes for some time now and served our clients extremely well over the past 18 months. And we all are, should be still considered a peer bond fund in client portfolios. And if so, what is an active bond fund? We'll unpack that a little bit more. And then AI is generally considered to be the next significant technological inflection point. And we will have an in-depth look at AI technology to better understand current trends and the impact thereof. It's my great pleasure to welcome our presenters this morning, Vanessa Naidu from Granate Asset Management and Ian Brink, equity analyst at Argon Asset Management. Good morning, gentlemen. Thank you for your time this morning. How are you doing?
Very good. Thank you, Eugene.
Very good. Thanks.
Really great to have the both of you here. I took a sneak preview of your presentation and it looks really interesting. So let's get underway. Vanessa, you up first, so you can start sharing if you're ready.
Do you see the presentation?
Presentation's coming through. Yes, I can see it absolutely fine. And to our audience, you know how it works by now. In the Q&A bubble, you can post questions and we'll cover those questions after both presentations. Vanessa, again, thank you. We are ready for you. You can start. Thank you.
Well, thank you for having me in. I've always been on the other side of the screen, so I'm quite excited to be here today. Today, I want to delve into three questions. Three questions that clients have asked us over a period of time. Questions that actually led to the launch of a new fund. Those questions are, what have been the key drivers of Granate's fixed income returns? I mean, we've had a consistent returns for a long period of time, and clients wanted to understand that. Question two, why don't you manage a bond fund? Which was a fair question at the time. And question three, which is still very relevant today, is when is the right time to sell normal bonds in favor of inflation-linked bonds, or to sell a normal bond fund in favor of inflation-linked bond fund? But let's delve a bit more into these questions. To my mind, or we believe, the key strength of the fixed income returns that you've seen is because the people that you see on the slide. I work with very talented individuals who have strengths across the risk curve. But the true beauty of working in this team is that we operate as a single team. If you just look at the fixed income team in isolation, we've got Bronwyn, who's always looking for the next best risk-adjusted opportunity. You've got a leader who's analyzing credit and who's looking into the secondary markets for when those opportunities appear. We got Melanie, who's just recently joined us, who brings us macroeconomic knowledge and expertise into the mix. And then it's not only the qualitative expertise, it's also the quantitative expertise that Nsovo and Caroline bring into the fixed income team. But like a true salesman, I'm like, wait, there's more. We also have this wonderful equity team that brings this local and global knowledge into the mix. And collectively, I think this is where the strength comes in. It's the fact that we operate as one team. We sit in one room, we sit alongside each other around one table, we scrutinize and debate the same information. And what that allows us to do is to have nimble and flexible thinking around asset classes and the relative value. And it also allows for non-binary thinking, which we believe leads to multi-scenario portfolios, which is to the benefit of our clients through different seasons and the changes of those seasons. Now, I'm an engineer by training. And the one way we thought about to describe this is to think about getting into a beautiful car. And you're driving on a long road to a destination that is very rewarding. Now, what do you need from that car? Well, you need an engine, a fairly powerful engine that will give you good output. But you also need a good range of gear speeds to give you all these possibilities on your journey. Now, you can think of the people that you saw on the previous slide as the engine. The engine gives you that output. And the gear range possibilities, those speeds, we can utilize that output in so many different possibilities. And what that means is that we find that the journey is a bit more a pleasurable journey. It's a consistent one. And in terms of fixed income, or from an investment perspective, rather, we can think about it as actually active asset allocation, because we're looking at the relative values of asset classes, and we can think about it as instrument selection, so that's security selection. And the combination of that altogether with the phenomenal team leads to the consistent returns that you have seen in the fixed income funds. The second question is a fair question. Why don't we just run an ordinary bond fund? Now, it's not to say that we can't run the fund. We can. We think part of our strength is finding those key instruments that offers value. And in an ordinary bond fund, it's about actually selecting which bonds are going to offer the best value. But for our clients, is it using the best engine output? Is it using our capability to the max? It's like driving in one gear. You're only using one of the possibilities that are available to you. Whereas instead, we think by using the range of possibilities and using the range of assets, we can hopefully have a much better trip, a much better drive. So, and this is a very relevant question. When do you switch from those nominal bonds or those fixed rate bonds into a bond fund or into an inflation-linked bond fund? And Eugene, we just spoke a few minutes earlier. It's a very hard thing to do. It's almost like trying to time the market. It's like driving down that highway and trying to figure out when I should be driving and when I should be trying to overtake and switching lanes. But the thing we thought about it is that the only way to think about investing into inflation-linked bonds and nominal bonds. So perhaps there is another way. I think this is a good segue into just chatting about the market and chatting about those nominal bonds and those inflation-linked bonds. Now you can see nominal bonds have had a phenomenal time of it. At the moment, they sit between the 15 and 20% range. And if you compare them on average to what we've seen in the past, you've got bonds would give you somewhere between 5 and 15%. I think the key thing to pick up on this chart is that this type of returns doesn't happen frequently. It happens less frequently. And it's something to bear in mind, especially when we look at the next slide. The one thing you have to realize about bonds is that the destination is rewarding. You do get positive real returns over time, especially in the recent past. But there also needs to be a realization that nominal bonds can easily go from plus 20% to minus 5% over a short period. So it's like driving on this rocky road. You're going to hit a few bumps. You're going to get to that destination, which is rewarding. But it's not just a smooth ride, and you have to be prepared for that. And linkers, unfortunately, I mean, the question right now and then the debate that's happening within our investment team is, are they overlooked and a bit underappreciated? Like you mentioned earlier, Eugene, in the last 2 years, I mean, no one's really got this right, but perhaps because we're trying to almost time it. But I think one of the key things to realize is that there is a place for inflation-linked bonds in your fund. We just compare them on a historical basis, and what you can see is that linkers can outperform nominal bonds on a month-to-month basis 44% of the time, which is a lot closer than you'd think. So there are times where they can be rewarding. And now, while it doesn't seem obvious, we need to just bear that in mind. So, because of conversations with our clients, because of some introspection that we had, and because we had some careful consideration, we decided 3 years to launch the Granate Active Bond Fund. And what our aim here is to deliver bond-type returns, but we want to make the ride a bit smoother. So we're trying to target an all-B return at much lower volatility. And the idea is to use the full output that Granate gives you. We're using the engine that is our investment team. We're using the full range of gears that's available to us to consider all possibilities. And what that means for this type of fund is that you consider all the asset classes that's available to us, that being cash instruments, inflation-linked bonds, credit bonds, and nominal bonds. But it is tilted towards nominal bonds because that is largely what we're trying to target, and that has been the main outperformer over time. And you can see by using these different asset classes, what it leads to is a much lower drawdown. If you consider that an all bond index, which is the nominal fixed rate bonds, the maximum drawdown peak to trough is about 10%, minus 10%. But if you could add inflation linkers as per our benchmark, and you add cash instruments into it as marked by the STIFI, you end up with a drawdown of about 8%, minus 8%, which is a much smoother ride than you would have had in an ordinary bond fund. And the other thing to realize is that the benchmark that you see is a compass. We are still utilizing all of our capability. We are utilizing our ability to do this active asset allocation and find these wonderful instruments that we can invest into our portfolio. And that ultimately, in the 3 years that we've been managing the fund, has led to outperformance. I think the final point that I want to leave you with is that Granate thinks about this as a long journey. I mean, this fund came about because of conversations with clients. And we understand that it's not an ordinary bond fund, but it is a bond fund that alleviates the anxiety of trying to figure out when I should be in the different asset classes. When should I be in inflation linkers? And when should I be in nominal bonds? It's the fund that uses fixed income nuances and considers risk management to get you to that same destination, to get you that bond returns, but ensures that your ride is a bit smoother. Thank you.
Thanks, Venetian. I don't see any questions yet. I've got a couple of questions. There's one coming in now. We'll deal with it after Ian's presentation. Ian, you can start sharing if you're ready.
Okay, so we're going to jump straight into the presentation. Thanks, Venetian. Thanks, Eugene. My name's Ian Brink. I'm an equity analyst for Argon Asset Management. There's a couple of slides in the presentation about Argon, but I'm going to get straight into the meat and potatoes of the presentation. And we call this the AI dilemma. So what we're going to do is we're going to explain this dilemma. We have this very influential technology. Everybody agrees that it's going to be a significant technology inflection point. It's still very early days in terms of implementation. We can't ignore it in terms of valuation. So we're going to look at some of the pitfalls around valuing this at a very early stage. And we'll also look at some of the factors impacting the implementation of AI. Specifically, we'll hone in on Tencent and Prosus and speak a little bit about what they are doing in this regard. So Joseph Schumpeter was an Austrian economist. He popularized this idea of creative destruction. Essentially, it's a phenomenon whereby which new technologies come in and disrupt existing technologies and products. It's great for economic progress because it kind of purges the system of old legacy inefficient technologies, but it can be detrimental to specific industries and companies. And there are numerous examples of where familiar brands have been made obsolescent by technological developments. I think there's general consensus that AI is an influential technology. There's a lot of money being invested into AI, a massive amount of money, even though the return profile is mostly uncertain. And companies feel the pressure because they want to avoid this creative destruction scenario where they're made obsolescent. But the reality is that there's still a lot of uncertainty around the full scope of implementation of AI. And the reason why there's such a lot of uncertainty around the implementation is because this is such a broad-ranging technology. Implementation will differ from one industry or company to the next. There'll be multiple points of influence per industry or company. There's also a direct and an indirect impact. So for example, if you're part of the AI value chain, AI will affect you in a very direct way. But if you're an ordinary company, you're not a technology company, changes in the way things are done, if they become more efficient, if certain parts of the business become obsolescent, if certain things become autonomous, or new business opportunities arise, that will also affect you. And in actual fact, if you just look at the arrival of AI, it's had a significant impact on one of Prosus's businesses, namely EdTech, which is educational technology, essentially online learning. You had AI come along, and overnight, part of that functionality can now be done by AI, which means that businesses being impaired. There's also some behavioral factors to consider. Whenever there's a lot of euphoria and excitement around something, we run the risk of getting into sentiment-driven decisions, market bubbles, irrational valuations. Management knows that AI is an exciting term. It gets investors excited. So they can kind of distract from poor performance elsewhere in the business by talking about AI. And we have these blue sky promises that are going to come just over the next year, but that's still on implementation. At the end of the day, as professional investors, we obviously need to also consider this in our valuations. And I think we're still at the stage where there's insufficient information to actually do a valuation, but we can't ignore it. We need to be on the lookout and consider it. So what we're going to look at is we're going to look at some of the developments shaping AI implementation, how AI itself has evolved, some of the politics around AI, and how AI can be combined with what they call platform economics in order to create, excuse me, in order to create enhanced engagement with clients. We'll specifically look at Tencent and Prosus as well, what they've implemented so far, and we'll answer the question as to whether we can value AI at this stage. And I think it's important to understand where Tencent and Prosus fit into this space. So as a technology company in China, Tencent does participate directly in the AI value chain. So it does provide some cloud infrastructure and computing facilities, which it then on-sells to other enterprises in order to train their AI models. It has some exposure to model development and R&D through its associates, and we'll highlight one interesting one there. And it also has applications which uses third-party models. Prosus is not really embedded in the AI value chain, so it looks more at ecosystems using existing models. It does some of its own model development, but they're high-level models which use existing native AI models. Excuse me, I had a frog in the throat there. So as AI evolved, so we went from causal AI, which was trying to understand cause-effect relationships and answering the question as to why something is happening. Then we went from there, with this understanding of the cause-effect relationships, we moved towards trying to predict what will happen, and that was predictive AI. There was quite a big leap between predictive and generative. Now we're giving this AI model some sort of information, and it is generating content based on that information. And then lastly, we made the leap towards agentic AI, which is essentially a model which behaves autonomously. It's proactive, it's goal-orientated, it learns from its previous interactions, and it's capable of using other models in order to achieve a complex goal. So there's actually an interesting example of this. A company called the Butterfly Effect, which is backed by Tencent, launched their Manus model in March 2025. It uses other specialized AI models. You can kind of prompt it, ask it to do something for you. And some of the things that it can do, for example, is plan your travel itinerary, can manage your inventory, it can do basic financial statement analysis. It makes use of other third-party models and open source functions. Open source functions are generally free. And so it was able to do these fairly sophisticated tasks at a fraction of the price of what models like OpenAI could achieve. It also makes use of something called a virtual machine. So essentially, what that allows you is to use off-the-shelf cloud computing, and you upload the libraries necessary for the model into this cloud computing space, and it creates the software environment. Now, the significance of that is that you don't need purpose-built bespoke hardware to run the model. You can use standard off-the-shelf cloud facilities, which lowers the cost. As with all things, politics has an impact on it, and we know that the modern semiconductor industry, as we know it, was largely born out of US intellectual property and research and development. It was actually surprisingly a relatively small group of individuals and firms that gave rise to the modern semiconductor industry. Very early on, there was this connection that was made between US hegemony, or global dominance, military supremacy, and precision weaponry. And that was underpinned by semiconductor technology. So, for example, if we look at the Vietnam War, the missiles that the US was using against Vietnam during the war didn't have any guidance systems. The accuracy of those missiles were 9.2%. So they hit the target 9.2% of the time. They were dumb. They didn't have sophisticated guidance systems. With the addition of semiconductor guidance systems. And we're not even talking about advanced semiconductors, 1 or 2 transistors and a couple of laser diodes. They were able to improve the heat rate of those missiles to up to 70 to 80%. So it's quite clear from very early on that semiconductors were of strategic importance to US global dominance. At some point, however, in order to access markets where there were lower labor costs, the US had to offshore some of the production of these semiconductors. They did so in a circumspect way, and they only really chose Asian allies that were politically aligned with the US. Be that as it may, there was some knowledge transfers, and that did lead to some market disruptions. So for instance, in the late 1980s, Japan actually disrupted the memory chip market, or this dynamic random access memory market. That was in fact a market which was born out of Intel. Intel was created to exploit this memory chip market. And as things stand today, Japan and South Korea essentially control that market. So Intel was actually forced to pivot towards bespoke manufacturing of CPUs at around about the time that a young man by the name of Bill Gates needed an operating platform for his DOS operating system. And so the PC era was born, and that kind of revived the US chip industry. Now, this area of precision semiconductor manufacturing is highly CapEx intensive. It's incredibly difficult to replicate. The technology is evolving all the time. So according to Moore's Law, you're trying to kind of put more and more transistors onto a silicon wafer every 2 years. And we're now in the order of billions of these tiny little transistors using sophisticated photolithography to etch. And it just increases exponentially all the time. So to replicate that and to go into that business is an art all of its own. And so a gentleman by the name of Morris Chang decided, what if we could split out chip design from precision fabrication? And he started a company called TSMC that focused on precision manufacturing and fabrication of semiconductor technology. And that had its pros and its cons. On the one hand, it kind of created this monopoly in terms of companies that were able to do this type of manufacturing. So there's only very few companies that can do it at that level, TSMC, ASML, etc. But it allowed other companies like NVIDIA to focus their research and their CapEx on chip design. And that's what actually got us to these levels of sophistication, because companies that did chip design could focus on that. And just to give you a sense of how advanced this technology is, back in 2020, companies like TSMC, and in fact, I've got a picture there of Fab 21, were able to etch a shape onto a silicon wafer that was half the size of a coronavirus and 1/100th the size of a mitochondria. So in the modern day, China perceived to be the biggest threat to US global dominance. Obviously, the US wants to control access to AI technology. NVIDIA is the manufacturer that produces the most sophisticated AI chips. And so what the US has done is it prevents China from accessing these incredibly powerful chips. It only allows them to access much less powerful chips from NVIDIA to try and slow down China's progress in AI. Chinese companies have tried to emulate NVIDIA's technology. It's incredibly difficult because they can't match the precision fabrication. And so what they've resorted to doing is taking less powerful chips that they've manufactured and combining it into kind of a matrix. But that has disadvantages in terms of power consumption space, and they haven't really been able to emulate NVIDIA's processing power. What they have done is they've been quite innovative in terms of the way in which they train their AI models. So DeepSeek was launched at the beginning of 2025. It was a large language model, which was able to approximate the performance of the much more sophisticated open AI model at a 20th of the cost. Now, as investors, that concerns us a little bit because it then challenges the amount of CapEx being spent on AI models. The way in which they achieved this performance was through smart training shortcuts, one of it being distillation. So they took this big pile of training data and they put it through a pre-training process using a more sophisticated model in order to whittle down that stockpile into a smaller stockpile of data, and then trained their model, their DeepSeek model, on that smaller pile of data. So what that meant was that they needed less processing power because they were training on a smaller data set. They also made use of open source frameworks, which is essentially cheap and for free most of the time, and virtual machines, which reduced the cost further. So let's get into the nitty-gritties of what Prosus is doing with AI. They want to invest about $100 million in AI per annum over the next few years. That's on technical staff, model development, and infrastructure. They've got a library of about 800 AI models. They've also adopted this iterative approach to developing models. So they come up with a hypothesis. They test the model. They build the model. They test it. If it works, they keep it. If not, they discard it. Now, that type of iterative experimental approach is only possible because they make use of platforms like DeepSeek, which is more cost-effective, so they can experiment in a cost-effective way. Two other major projects they're looking at is their large commerce model and also a workforce AI system called Token. The Token is essentially a tool that the staff uses internally. For example, let's say you as an analyst working for Prosus wanted to draw a graph. You go to the tool, there's a natural language interface. You say, can you draw me a graph of A versus B? The system would then go out, look where the database is located on the database, pull the data, format the data, and produce the graph. And obviously, there's a massive efficiency in terms of saving on analyst time. The other big project they're busy with is something called the large commerce model. Essentially, this seeks to exploit what they call platform economics to create a digital lifestyle platform. So they're experimenting with this in Brazil, where iFood is the most popular food delivery application. So you create this digital platform, you have iFood as the core of that platform, and that's the high frequency application. That's the one that people are coming in to use most frequently. Then what you do is you start adding peripheral applications around that core application. So in other words, you have one acquisition cost to get people onto the platform, but you have multiple monetization opportunities. As people are transacting on this digital platform, you're collecting transactional data, and you then use that data, feed it into an AI model, and you create this kind of digital profile of the individual. Now you can start doing very clever things. So for instance, if you know someone is very health conscious, they gym 5 days a week, they enjoy a chicken salad. You can now push them an offer, 8:15 on a Tuesday, give them a 15% discount on a Kauai chicken salad, and the chances of them picking up that offer is significantly higher than if you just had a kind of random promotion that you were pushing at them. Alternatively, you might have someone who's going to do some international travel. It might go onto this platform and say, can you send me a scheduling plan? I want to go to Europe between this date and that date. Could you also send me a proposed itinerary? I want to see A, B, and C. And you could then have an agentic AI linked to Despegar, which is the online travel application on this platform, send you this traveling schedule and itinerary. Tencent's also doing some interesting things. They've got their own large language model called Wanbao. They also use AI in the online advertising business. That's a part of the business that's actually growing very rapidly. And they use it in automated approval of ad content, tools for creating advertising content, and they also do that personalization that we just discussed in order to improve click-through rates on the online ads. They do some essentially sales of computing infrastructure to very specific clients in order for those clients to train their AI models. But remember, we spoke about the restriction on GPUs and hardware chips. And so they only do that to very specific clients because it's quite costly and difficult to gain access to those GPUs. They also have applications for building customer support systems and real-time transcription and content generation in their enterprise business. And then lastly, they're doing some interesting things inside of their games business, which is a big part of the business as well, where they use AI to make gaming more realistic, and they have tools to create 3D content, which developers can use as well. So most importantly and lastly, how do we think about valuation? So at Argon, if we want to value a company or an opportunity, we need to first of all forecast the normalized earnings. So this is kind of the sustainable through the cycle earnings of this business opportunity. We then need to apply a fair exit rating to that, right? And the product of that gives us the valuation. So that fair exit rating is essentially a valuation multiple, PE, that captures the return and risk profile of the opportunity or company. Now, at this stage, it's very early on in terms of the implementation. Companies are still really figuring out how they're going to use AI. They're playing around with certain things here and there. The way I see it is we are starting to see certain impacts of AI coming through in terms of operating metrics. We're still very much reliant on management to tell us that's because of AI, because we can't see, you know, we on this side of the veil. At a later stage, that operating performance will translate into financial performance, and then beyond that, we will be able to start extracting things like revenue, margins, capex investment, and returns. And then we'll be able to do a more comprehensive standalone valuation for AI. So in conclusion, implementation hasn't fully been figured out yet. We're starting to see some evidence of implementation in terms of operating metrics. Processes explain to us how AI fits into their strategy. That's incredibly useful. It's a lot better to understand, a lot easier to understand the company when we know what they're working towards, and it's a lot better than, you know, the kind of proverbial spaghetti on the wall. Tencent, we are seeing some tangible performance improvement, especially in the online advertising business. They're usually a bit better and have a shorter turnaround in terms of talking about something and actually seeing it come through in the financials. But at this stage, you know, we're very much still in the investment phase of AI, where companies are still building skills, models, and platforms. But knowing how AI fits into the business does help us better understand trends and does help us with our modeling of the business. Thank you.
Ian, thank you very much. Very interesting indeed. If I can maybe mention to the audience, I know you are in the process of launching an equity fund. We will probably see a lot more of these concepts being pulled into the fund. Maybe just quickly on the equity fund that you are busy launching, is that a SA equity only fund, or does it include global as well?
Yeah, SA equity only. It will be SA equity only.
Okay. If I look at your, yeah, sorry.
Yeah, and we're in the process of seeding it, so there's a couple of weeks turnaround. That fund will then come live.
Yeah, and likely see it on platforms within the next month or so, but we'll keep you posted as well. Yeah, maybe just quickly, in your absolute return fund, if I look at your equity carve-out, which is a smaller component because that fund is predominantly in fixed income, but you've got some exposure to gold. I know we're stepping off the AI theme. I'll come back to that just now. But I know there's a lot of questions out there on gold. You know, is it something that you still include in equity portfolios or equity funds? And is it a hedge, or is it there to actually get some of the gains that we've seen from the gold rally?
Yeah, we do have some exposure to gold. We kind of had guardrails around our exposure to gold. Obviously, the price has run quite hard. So on a valuation basis, we're not really overweight. We're still underweight, but we do have some exposure as a risk mitigation. Yeah.
Getting back to AI, I mean, that very last slide of yours touched on a lot of ways of which we're actually trying to assess whether AI is assisting companies to be more profitable. But from an investor point of view, I mean, this whole AI thing, I think a lot of investors are still trying to get their heads around how do you actually capitalize on AI, or how does investors make money out of AI? Because it's not necessarily investing in AI companies. It's looking, and the examples that you use, it's looking into business models of businesses to see how they apply AI and how they improve the bottom line. Is that the understanding? Do I get it right?
So I think, look, if you're looking at the SA market, you have kind of less opportunities to invest directly into the AI value chain. Obviously, if you were looking at global stocks, you could invest in NVIDIA, for example, or ASML, or whatever the case might be, and then you'll have direct what I refer to as the direct impact of AI. But I think generally AI is just this phenomenon that's going to have such a broad-reaching impact on all companies. Perhaps tech companies like Process, especially when they communicate where they're fitting AI into their operations, it helps, and you can get some better sense of how AI will impact those businesses. But I think it's also important to note that there may be positive and negative impacts. So for instance, using Process, I use EdTech as an example. AI has pretty much wiped out part of that EdTech business. So yeah, unless you can invest directly into kind of the AI value chain, it's not that clear cut, unfortunately. I don't think you should necessarily think about AI in the indirect sense as investing in AI, but rather try to understand how AI will impact that business's operations. Yeah.
And that's obviously something you look at in depth, hence the presentation. Maybe just back to the equity fund that you're launching, and it speaks to one of the questions from the audience as well. Given the limited scope that we've got in SA in terms of securities, we know SA equity has actually done phenomenally well the past 18 months, and I think exceeded expectations across the board. But why SA equity only then, if you're and exclude some of the global players out there?
I don't know if it's necessarily that we exclude global players. So look, we look at SA listed stocks. A lot of those stocks have exposure to other markets. A company like Richemont or Process for that matter, essentially you're investing into 10 cents. So it's not like you're only investing into SA themes. It's just that we limited by our mandate to invest into SA listed companies. But we do also have some partnerships in place where you can gain access to global markets via, for instance, our offering of Allspring funds, which is a big international asset manager. Yeah, so it's mandate driven. But bear in mind that just because you invested in SA listed companies doesn't only mean you're accessing SA markets. You can be accessing stocks in other regions, global stocks as well.
It's all about where the earnings are coming from these companies, even though they're listed in SA. Vidishan, I didn't forget about you. I'm going to come to you now, but yeah, I just want to finish this conversation very quickly. And sticking to SA equity and looking at your SA equity fund that's about to launch.
Yeah.
That a lot of articles, especially the last 3 or 4 weeks, surfacing is it's very doom and gloom around SA. Giving tariffs and SA government not doing a hell of a lot to address that and to make peace with or to get some sort of deal going with the US. There's more articles surfacing on how a big part of the motor industry is going to shut down, all the potential job losses. We're not there yet, but it's hanging like a sword over our heads. And then it's very likely that SA growth will slow even further. Your view, just from a macro point of view, is this the time to run from SA equity? Because SA, is facing a hell of a lot of challenges.
Yeah. I think it's the perennial question. Our job as active managers is to look through all of this. There's always going to be issues. Obviously, there will always be cyclicality in the economy and in markets, but as active managers, this is our time to shine. We stick to our philosophy, we stick to our process, we value-based bottom up, and we look for those opportunities. Obviously, as the cliche goes, when other people are running away, we're running towards to try and unpack valuation opportunities. And that's what we do. That's what you pay us to do as active managers. Yeah.
And still finding us companies that can grow earnings regardless of where we are with our own economy. And I think we've mentioned that to investors and clients numerous times. Look at where the earnings come from, not necessarily only at SA's economy. Ian, very insightful indeed. Vidishan, I want to come back to the income side. You spoke of your active bond fund, but we're all very familiar with the Granate BCI multi-income fund, which is a multi-asset income fund, where all those things are being managed on our behalf, duration and yield and ILBs and, fixed and floating rate notes. Why an active bond fund? Why not just continue using a multi-income fund?
I think it's for different investors, to be honest. If I think about our Granate multi-income fund, it has a very strong track record. It has consistent returns, but the point of that fund is to make sure there is consistency. It's almost allergic to volatility in some sense. It's for that client that's approaching the end of his career and is looking for that steady income. What this fund is for someone that wants the higher total return. That's someone that wants to gain those phenomenal returns that you can get from bonds, and is willing to take a bit more volatility, but ensuring that we can utilize the full suite of asset classes or the full suite of instruments to us to be able to get there, as opposed to just using this one specialized tool.
Absolutely, and it's exactly that. And if we look at bond returns over the past 12 months, I think we were all pleasantly surprised. SA equity did well, but bonds almost outperformed SA equity. And if you look over long periods, bonds actually stood investors exceptionally well. Just looking at your active bond fund, just for a better understanding, and people normally try to get a sense of what the yield is and what the duration of a fund is, to try and get some sense of what the fund can potentially do for clients. What's your duration at the moment, and what is the yield?
Our duration is about, including ILBs, about 5.5, so about 5.46, if I remember correctly. And our yield is probably about 10.6%. So you can see that when you spoke about comparing the income fund, an income fund roughly probably gives you a 9%, but this fund can invest into this long duration bonds and take a meaningful weighting there. So you can get that additional yield pickup, as well as from other instruments. And that's how you get to a yield that is probably far beyond what you would get in an income fund.
We saw SARB cutting rates, but we all know by now that we are likely in a higher rate environment for some time to come, so we're not in this sharp drop off of rate cuts. Everybody's taking it slow, especially the Fed, very cautious at the moment. What does that mean for investors in a bond fund? I mean, is that positive because your investment rate just continues to be higher? Or should we be worried that we maybe not going to see all those capital gains that we've seen for the past 12 months?
Yeah, so I think the one chart that you mentioned, I mean, to your last point, to get that type of capital gains again over the next 12 months would be extraordinary. I mean, we don't see that type of moves in bonds. But you must realize, by targeting low inflation like the Reserve Bank's trying to do, they're going to run higher real rates, which means that ultimately those yields will probably persist for a while yet. And the beauty of this fund is that it's not only married to just normal bonds at these high yields. We get good real rates that we are getting out of inflation-linked bonds, and we get good real rates that we're getting out of floating rate bonds. And we've actually found some value in offshore credit as an example. And we're utilizing all of those, and that ultimately gives you a higher yield and potentially a higher total return over 12 months. But you're not just married to how nominal bonds are going to do over the next 12 months. You're utilizing the full suite of asset classes that are available to you.
Makes a lot of sense, Venetian. A question from the audience, and it speaks to very high global and SA debt levels. And if you consider the debt level locally, what are the real risks associated with SA nominal bonds compared to what we've seen over the 10 to 15 years ago?
Yeah, I'd be lying with saying that is probably not the risk. The risk is that we continue along this trajectory that's been created, and that is fiscal risk that's increased. Our debt balance, I always try to think about our overdraft balance is just increased and continue to increase over the last 10 to 15 years. But there are good things that are happening as well. And it's not to say, the interesting part is our bonds are priced, while we think that it's largely priced for the risk and the low growth scenarios already. What is happening on the ground is that we've got these reforms, which hasn't necessarily translated into growth at this stage. but it could in 2 to 3 years. And the positive things are starting to come to fruition. The second part is that the National Treasury is very cognizant of managing that debt balance. So they're going to do their utmost to make sure that they're going to run what they call a primary balance. So think about increase your savings to pay down your debt. And that's what they're going to be doing. And that they've indicated that to the market, and they've done it in the last year or two. And they're actually collecting more than you would expect it, while the revenue services are. So all of these things point to us looking a bit better in the next couple of years. But we're not seeing it in the numbers as yet, and hopefully we will see it coming through in the future.
I think all on this call, the hair stands up straight when you hear about SARS, because indeed their collections are very, very effective. Venetian, last question from the audience. How active are you using credit in the active bond fund?
So we use it fairly actively. So the difference, I mean, you asked about the difference between the Granate Multi-Income and the Granate Active Bond Fund. The Granate Active Bond Fund will limit its credit exposure. We limit it to about 30%, or that's how we think about it, because it's not necessarily a credit fund. It's a fund that's trying to get you bond returns ultimately. But when there's value in credit, at least has the ability to use it. And right now, the interesting part is there's not a lot of value in South African credit. There's a lot of value potentially in some pockets of offshore credit, and that's where we're looking. And that's the beauty of working in this team. We have all this expertise, and everyone's looking globally, and you can find these niches and invest into them in a bond fund.
About 5 or 6 years ago, there was a lot of noise around prescribed assets, and it's a question from the audience again. Do you foresee prescribed assets by government within the next 5 years?
I used to work with a colleague, Andre Schmidt. He's long retired, and he said over his dead body, will you see that prescribed assets again? I didn't even know what he was talking about at the time. I don't think so. I mean, if we get to a situation of prescribed assets, I think we've got bigger problems. I think this government is cognizant of the fact that we need to grow, and that almost limits growth, and that's not the way to go. We want free markets here, not what they're trying, not restrictions almost.
And I mean, if you look at the bond auctions at the moment, most of the time it's oversubscribed. So people are buying our bonds, local investors like yourselves, and a bit of foreign investors as well. So why prescribe the assets if we're buying bonds in any way? So yeah, it's going well. So that deals with that. Gentlemen, I'm going to pause our conversation here this morning. The clock caught up with us. You made for a very interesting conversation indeed. Ian, we're looking forward to the launch of your equity fund. I mean, you've got an outstanding record on the institutional side. So really glad to see some of that entering into the retail space as well. And like I said, we'll likely see the fund on platforms within the next month or so. So we'll keep the audience updated. Venetian, thank you so much for your overview on bonds. Definitely a lot of scope there still for investors. So if you want a little bit more firepower for clients, please consider the active bond fund. It can really contribute to client portfolios. Gentlemen, thank you so much again for your time this morning and preparing for these sessions. It's always great to have you on board. And we'll keep in touch and get you on sessions to follow. Thank you so much.
Thank you very much.
Thanks very much. Thank you for the time.
To our audience again, thank you so much for joining us. Just a quick reminder, next week, Wednesday, the 13th of August. Can you believe we're there, almost there already? We've got Tony Bell from ThinkCell and Jurgens from ID Capital to continue our conversations. And we'll probably unpack global equity a lot more as well. And then on the 14th of August, we've got another hedge fund webinar. Always very insightful to see what's happening in the hedge fund world as well. Again, thank you for your continued support, and we'll see you next week, Wednesday. Thank you so much.